This podcast is brought to you by AJ Bell and Shares Magazine. Shares Magazine is published by AJ Bell Media, part of AJ Bell.
Hello and welcome to this week's episode of the AJ Bell Money and Markets podcast. I'm Charlene Young. Joining me this week is the fabulous Danni Hewson. Hi, Danni.
Hi, Charlene. Now, just so you know, we're recording this Wednesday just after lunch. So we're going to kick off with UK inflation figures released today before moving on to the latest on gilts and the pound and whether TikTok is still due to be banned in the US. Talk about a mixed bag.
Indeed. Now, what does another Trump presidency mean for Asian markets? Our interview this week is with Yoojeong Oh from Abrdn's Asian Income Fund. We'll discuss warnings from BP and JD Sports and the news that more people are living with their parents for longer. But let's get started with those latest inflation figures. The next Bank of England meeting isn't for another 3 weeks, but we've had some surprising news on December inflation, haven't we?
We have, yeah. It did catch people on the hop because the expectation was that inflation would hold pretty steady at 2.6% for the month of December, or there was the outside chance that maybe it would even go up a little bit. But in fact, it came down to 2.5%, which obviously with the volatility that we've been experiencing on markets over the past couple of weeks, and we're going to talk about gilt yields in a moment, it's been really welcome and markets have responded. They finally seem to have found a second gear. I mean, they felt like they've been in reverse for a while. Rate-sensitive stocks particularly buoyed, so housebuilders and utilities in particular doing well. But I think the key thing that most people have picked up on today is the immediate impacts that it had on interest rate expectation. So, as you said, the next meeting of the Monetary Policy Committee is just in a few weeks' time in February. And up until we got these inflation figures, but market expectation was about 60% that there would be a cut in February. A lot of that was down to the fact that, GDP has been particularly weak, unemployment sort of ticked up a little bit. But inflation being sticky was sort of one of those question marks. Immediately, once we got the inflation figures, the expectation of a cut in February jumped up to over 80%. And of course, that potentially bodes well for those looking to jump onto a new mortgage deal. We're going to talk a bit more about that. But yes, certainly for Rachel Reeves, the Chancellor, who's had a really tricky few days, the news on inflation will have been well received.
Thanks, Danni. Yeah, I think we mentioned last week the buzzword really felt, like it was volatility. And as you mentioned, we're recording this on Wednesday afternoon. And right now, things do feel slightly calmer with those bond jitters. I think 10-year gilt yields were holding steady in the lead up, at least to today's announcement. And the pound is still hovering out, or some might say rooted to the $1.22 mark. So yesterday, Chancellor Rachel Reeves was back from China. And I think it's fair to say she kind of hit back with her speech in the Commons. Do markets think she's done enough with that?
I think expectation from markets was pretty hot that she would have to say something to really make a difference. I'm not sure she went far enough. I mean, you're right, she did hit back, promising growth, more importantly, promising to give a blueprint for markets which would show how growth is going to be delivered, because that is going to be the key thing. We've seen, as you say, bond yield shooting up. The 10-year gilt yield was up above levels last seen in 2008 during the financial crash. The 30-year gilt yield was taking us back to the 1980s, late 1980s. That just sort of demonstrates how much volatility we've seen. I think it's really important to mention that it's been a steady increase rather than a short, sharp shock. But certainly the last week or so has really captured headlines. Business confidence I think, is the key thing here. And we had comments from the CBI saying that business has been bruised. We had the latest survey out this morning from accountancy body ICAEW, and they found that business confidence was at the lowest since Russia invaded Ukraine in 2022. And of course, the big thing is that business after business is warning of the impact on jobs and prices. So just today, we had a crowd-pleasing update from electrical retailer Currys. They had a great Christmas. They've restored the dividend. But the boss is warning that it intends to take on fewer staff because of the increase to national insurance for employers. And also pub group Mitchells and Butlers, which operates bars including Harvester and All Bar One chains, they warned of a one-off £100 million increase in cost pressures. Sorry, not one-off, year after year, obviously, coming their way. And Next last week came flat out and said that prices would go up. So just looking at market expectation for the way inflation is expected to go over the coming months, it's expected to ratchet up again. And, while we're talking about the fact that it looks likely that the Bank of England will have a path to cut interest rates in February, if you're seeing inflation, as many people expect, topping over 3% again, then that path reaches a bit of an intersection quite quickly. And, markets, although they're now pricing in 2 cuts this year, maybe on the off chance 3 cuts because of weakness in the economy. Certainly, if inflation does prove stickier for longer, then that is likely to, market expectation will change again. Because, of course, this is expectation. The Bank of England Monetary Policy Committee will ultimately make the decisions, and there's going to be a lot of data between now and certainly even the next decision, but the decisions afterwards. Look, the big concern for Rachel Reeves with regard to higher borrowing costs is the headroom that she has. And I know that it's March the 26th that the Office for Budget Responsibility will give its latest update on where it thinks the headroom is, how it expects the growth trajectory to be. And there have been a number of reports suggesting that the little bit of headroom that Rachel Reeves has been whittled away, and potentially she could find herself in a really sticky situation because she's kind of boxed herself into a corner, really, hasn't she? She said that there won't be any more tax rises, that she won't break her fiscal rules. So spending cuts is potentially the only thing left to her. And of course, spending cuts could impact growth. And there we go on that wheel again. The fact that we had seen such weakness in the pound really sort of demonstrates the fact that investors are a bit concerned about the growth trajectory of the UK, that they are insisting on a premium in order to take on that UK government debt. So the Treasury really needs to follow through. So not just talking about growth, but talking about really spelling out how they achieve growth. And although the headlines have been full of that, Charlene, when we're talking about borrowing costs, this does have a real life impact on ordinary people as well.
Yeah, absolutely. Kind of from the government's fiscal responsibility to actually how it impacts us at home. And I think it's probably important to spell out that it is different to before. Although yields are at those highs that you mentioned, it's different to the aftermath of that Trust Kwarteng kind of budget plan, as we aren't talking about the same issues particularly with pension funds and big pension funds, LDI, so liquidity-driven investments, and that kind of muted pension funds crisis with bonds when we were rattled then. In fact, actually, companies administering defined benefit pension schemes, those big pension funds, could actually see the value of their liabilities substantially reduced. So actually, those funding positions potentially swinging from a deficit to a surplus as a result of the spike this time around, a very different picture to last time. And people looking to buy an annuity with their own pension pot, with their individual pot, will likely be able to secure higher rates than before. Although, it's vital still, if you're thinking about purchasing an annuity, that you do shop around for the best rate to suit you. Now, as we mentioned, mortgage holders unlikely to be happy though, as higher yields do filter through to kind of tighter fixed rate mortgage pricing. And, it's not just homeowners. This could affect renters too if these costs are passed on by landlords. But maybe some hope for that rate cuts in a few weeks. But like you say, the path could look rather different to what was expected, a few months ago. Danni, back to those gilt yields as well. Like we mentioned, they have been at those kind of record highs. But as you said, the change in yields is nowhere near what it was sort of 2.5 years ago. And the UK, am I right in saying we're not alone in seeing rises, are we?
No, absolutely. Not alone at all. I mean, I was taking a look at US treasuries, 10-year treasuries, borrowing costs for France, Germany, Italy, all have seen government debt costs rise. But while in the UK, we're talking about multi-year highs, we're more talking about multi-month highs in other places. And that is because things are slightly different in the UK. And a lot of economists are pointing to what happened in the wake of that budget that we had at the end of October and the potential inflationary aspect of those national insurance increases. And of course, the increase in the national living wage, which will come in at the same time. Look, the United States, I've heard a lot of people talk about it as exceptional, that exceptionalism that we're seeing in the United States. We've got, incredible growth despite high debt. And, the dollar has just gone from strength to strength, particularly on the expectation that interest rates are likely to stay higher for longer in the US, which is now really being priced in. A lot of that is down to the fact that Donald Trump is about to set foot back in the White House again. Some of his policy plans are expected to be inflationary, things like tax cuts, tariffs if he implements them, although there was a sort of glimmer of hope, certainly from European markets earlier this week, when there were reports that he's expected to bring in those tariffs incrementally. So not just all in one go, slapping, 20% tariff on, but bringing them in month by month by month and sort of slowly ratcheting them up. But it was really interesting because late last week, we got a note from Bank of America suggesting that they didn't see the Federal Reserve cutting rates at all this year. And in fact, they thought that potentially the next move by the Federal Reserve might be to hike interest rates once again in order to stamp out inflation. And we have just had the latest US inflation number, and that came in higher than was expected, up at 2.9%. That's up from 2.7%. So, significant sticky inflation in the United States, but still growth and still a really strong dollar. And, in terms of the Eurozone, we've already seen far more cuts from the European Central Bank in the Eurozone than we've seen from the Bank of England to interest rates. And there is an expectation that the interest rate will go lower still because inflation's not looking quite as sticky, but more because the economy is looking really bad. I mean, Germany in particular is really struggling to find a forward gear at the moment. So, yes, we are seeing rates, those bond yields up globally. We know that a lot of the reason behind the increase in bond yield is tied to what's going on in the United States and the expectation, particularly of tariffs. But the fact that we have seen the pound looking really lost its way. I mean, it lost a lot of strength, particularly against the dollar, but also against the euro as well, does hint that things are maybe not quite as well in the UK in terms of the economy as in other parts of the world in that area, and just sort of a worry really about where the UK economy goes in the next few years.
Yeah, and I think kind of with risk and uncertainty, stripping over my words there, some people see that as an opportunity, and we had some really interesting data from kind of what our customers has been up to. And we've been busy chatting about kind of the longer dated bonds and gilts being sold off, but our retail investors and customers are actually sort of piling into both UK and US government bonds. We feel the yields they're believing those yields are creating what they feel is an opportunity, if you like, to lock in a yield above, say, 4%. So kind of why are they doing that? Well, if you think the higher those government bond yields go, there becomes sort of a greater competition against stocks, equities for people's money. So at some point, some people might decide that actually, look, I can get a really decent yield from a bond for a lower risk, in my view, compared with investing in stocks. And of course, if you're looking at gilts, they're also exempt from capital gains tax if you're operating outside of those ISA and pension wrappers. And going back to kind of investment theory, if you like, the yield on those 10-year UK, all of those US government bonds is often deemed what we call the risk-free rate. So that kind of theoretical rate of return you get for an investment without, subjecting yourself to any risk. And the reason we call it that is because, neither the UK nor the US government is expected to default on their bond repayments, which kind of gives their bonds that risk-free status, even though, we wouldn't describe them as 100% guaranteed. And, in terms of risk, though, you still have inflation risk, as we talk about a lot, interest rate risk, on top of liquidity risk, although that one, maybe less of a concern if you're going to buy at issue and then hold for the long term. So, on one side, we're seeing this kind of institutional sell-off, but individual investors, looking out for opportunities there. So I thought it was just really interesting thing to point out. Now, onto trading updates. So we've heard from BP and JD Sports, haven't we, sounding kind of alarm bells, and another warning from PageGroup on weak job markets. Danni, can you just kind of talk us through what's been going on there?
Yeah, I'm going to rattle through these. There have been so many trading updates. We could have filled the entire podcast just talking about them, but I just wanted to pick out a couple that caught my eye. And I think a lot of investors maybe think that BP and its peers, those big oil giants, are doling out endless dividends, share buybacks, and making gains with ease. But actually, they're operating in really quite a high risk environment with unpredictable earnings. And we just had a profit warning from BP saying lower production and weak refining margins will impact its fourth quarter results, and it sort of sours the recent recovery in its share price after what's been quite a prolonged weak spell. Concern about the global economy has really put a cloud over oil demand this year, and BP's latest update really continues its run of bad news, having suffered impairments and warning of weak refining margins last year. As I say, they're not alone. Shell has warned of weakness across multiple divisions, and ExxonMobil signaled a $1.75 billion drop in fourth quarter earnings. Although in the past week or so, we have seen the oil price, well, since the start of the year, I think the oil price up considerably, over $80 a barrel, which we haven't seen for a while. JD Sports, I thought, was worth talking about because it really was a stock market darling for a while. A collector's favorite. People, certainly younger people, my kids included, like to spend an awful lot on trainers and keep them pristine in boxes sometimes and then resell, hoping their value will rocket. And JD Sports was on track a couple of times to deliver £1 billion in annual profits. But that particular milestone has been kicked down the road a couple of times, and it's now become a collector of profit warnings. So it's already guided down full year expectations. That was back in November. This week it said profit's going to be even lower thanks to weak trading in the UK and US. So, we had Chief Executive Regis Schultz joining in 2022. He had big plans, but I think Dan Coatsworth put it really well when he said that his 9 lives are nearly up because the business seems to have really spluttered under his leadership, and the share price has fallen by a third since he became CEO. And just finally, while we're talking about the economy, a lot of people look towards recruiters as being something of a sort of early warning system for the state of the economy. And when you look at the FTSE 250 listed PageGroup, shares fell over 4% after it announced its second profit warning in just 6 months. Now, I don't think anyone will be surprised that we're seeing recruiters really struggling at the moment because there's been a hiring slowdown, not just in the UK, which has been discussed a lot since the budget in particular, but also in other countries. So in Europe, key markets like France and Germany have really had a hiring slowdown, and that's been exacerbated by concern about Donald Trump and potential tariffs. Now, on the other hand, PageGroup saw profits in the US actually growing for the first time in 2 years in Q4 with an increase of 3%. But I think it's probably a little bit early to consider it as sustained growth because, we've got Donald Trump coming in, and although the expectation is that he'll deliver on his Make America Great Again promises, how that sort of follows through into hiring plans, well, we're just going to have to wait and see what that does. But we also had Robert Walters, another recruitment giant, slashing more jobs, saying that the hiring market continues to face challenges.
But maybe some better news for UK house builders, indeed, thanks to that kind of buoyant update from Persimmon.
Yeah, FTSE 100 house builder Persimmon told the market that it expected profit for the year to be ahead of market expectation. We've heard a lot about the state of the housing market, the impact of higher mortgage rates to confidence. But the firm said it had delivered more homes, up 70%. That's not 70%. That would be quite impressive if it had delivered 70% more homes, 7% more homes on the previous year. And coming in above market expectation helped as well by the fact that the average selling price was 5% up on last year at around £268,500, really reflecting improved market conditions, with Dean Finch, the chief executive, saying that customer inquiries and sales rates have been consistently ahead of the prior year since the spring selling season. So, during 2024, we did see quite a strong recovery from the housing market. And when we're talking about record highs, near record highs, in terms of house prices, that is good news for house builders. It's good news for anyone already on the housing ladder. But for people trying to get on the housing ladder, first-time buyers who are trying to get a decent chunky deposit down, it's hard, and it is having an impact on people's lives, Charlene.
Yes. Yeah, we spotted a report this week from the Institute for Fiscal Studies showing that more and more people in their late 20s are still living at home. So the report, if you'd like to have a look, is called The Hotel of Mum and Dad. And the kind of main headlines I wanted to pick out from it are, the proportion of UK adults in their 20s and 30s, so it's kind of late 20s, early 30s, living at home with their parents has risen by over a third over the last 2 decades. Now, putting that into actual numbers, this represents around 450,000 more 25 to 34-year-olds living at a parental home compared to 2006, which is a huge amount, or a huge increase. So actually kind of delving into who is still staying at home. So it's more common for young men than it is for young women. So the rates of co-residence for young men in 2023 to 24 were 23% compared to 15% of women in that age 25 to 34. age group. And, that's coincided with lower rates of parenthood and marriage. And, actually the IFS has found increased reported experience of ill health in that age group over the same period as well. And, as you mentioned, new houses being built, plenty of demand there, but, no surprises that most of the explanation for this comes down to affordability. House prices remaining high relative to earnings for this age group, and they're facing a backdrop of rising rents and past rises in interest rates. So just saving for that deposit for that first time home is just harder and harder than ever, and a real pinch point for those people. Those willing and able. I mean, I'm casting my mind back a few years to that point. I can't imagine sort of having moved back in with my parents, but those who are willing and able to do it are likely to therefore have the ability to reduce some of their debts that they might already have, increase their saving, or actually increase their spending and have a decent lifestyle compared to if they were living in high cost private kind of rented accommodation. And we talked about that call for evidence from the Treasury Select Committee on the lifetime ISA last week, seeing if it is fit for purpose. And we talked about it. It's a great way to get on the housing ladder for the right people, but lots of people are simply having to stay at home to be able to kind of cut their spending or give their savings a boost in the first place to even get a chance of, a bite at that lifetime ISA bonus cherry and make up that first deposit. So, you can see the results of it being borne out in reports like this one from the IFS.
I must admit, when I heard this report, my blood ran a bit cold because I'm heading to a point where my kids are about to disappear off to university and then hopefully into the world. And certainly my husband already has plans to turn one of their bedrooms into his office, which I'm absolutely steadfastly refusing to deal with. But the thought of them still living with us at 28, 29, 30. Yeah.
Yeah, I think it was the age that really, kind of sprung out for me. Fair enough if sort of like boomeranging back after university for a bit, but, age 34, 35, I'm only 38, feeling all of those 38 years at the moment. But it's, I can't imagine it, but, like you say, empty nest acting out slightly differently in your house there between you two, Danni. Oh dear. Right. Let's head across the pond. We've talked about the Donald quite a lot. And, Donald J. Trump's second inauguration is set for Monday the 20th. So he will be back in the White House by the time we return for next week's episode of the pod. With that in mind, Danni, you spoke to Yoojeong Oh from Abrdn's Asian Income Fund about how a Trump second presidency could impact Asian markets, especially on those tariffs that we talked about. And actually also how many investors don't particularly or maybe realize that, good income companies can be found in Asia. It's not just growth stocks.
Thank you so much for joining us. Look, I think everybody at the moment is just focused on the fact that we are days away from Donald Trump's return to the White House. Markets already experiencing volatility because of the potential for tariffs, changing expectation as well of the rate cuts from the Federal Reserve. What are you most focused on?
So I think you're right. And we're also looking at what's going to happen next week in the White House as well. I think if we look in Asia, then a lot of the emerging markets here are export-dependent economies. So obviously there's a lot of tariff conversations going on, and that creates a lot of uncertainty for manufacturing and technology industries, as well as having repercussions for the entire supply chain and future factory footprint decisions as well. I think equally significant is the potential impact of Fed rates on Asian markets, especially when there's uncertainty over direction, as we've seen recently, with rate cut expectations being revised down for 2025. So lower rates can support liquidity and boost investor appetite for growth stocks, but they can also make dividend stocks look really appealing relative to lower rates on bonds and savings. And on the other hand, of course, higher interest rates can turn off the tap for cheap funding, making value and yield stocks more appealing to equity investors. But high rates obviously also come with strengthening dollar a lot of times, which could impact Asian corporate profit margins.
Yeah, we've certainly seen that strengthening dollar over the last few days in particular. Look, let's double down on those tariffs, because I know Asian markets, as you say, in particular, are expected to be impacted. Is that making investors generally more reluctant to look east at the moment?
Yeah, so there's a lot of changing expectations around that level of tariffs that the US will set on China, but as well as on the rest of the world. So whatever that tariff policy announcement is next week, we expect any change to be gradual, as an aggressive step up in tariffs will also affect American consumers, as it will result in cost inflation on goods imported for purchase by US consumers as well, who are ultimately US voters. So a lot of incentive to keep them happy from the White House. I think trade tensions, especially between US and China, that can weigh on the broader Asia sentiment. But Asia offers a lot of diverse opportunities beyond that pure export-driven commodity product manufacturing. And I think investors should look at price volatility as an opportunity to access that longer-term growth story in Asia at a better valuation. And the domestic consumer story here in Asia remains very strong, for example. So 130 million people are expected to join that global middle class in 2025, of which 3/4 will be added in Asia. So for us and the Abrdn Asian Income Fund, we're really looking for those high quality cash generative companies with strong business moats that can grow earnings and pay dividends, regardless of the short-term market volatility. So we're trying to make use of these short-term moves to buy good quality stocks at good valuations that can be both earnings and dividend compounders over the long run.
You just said you're an income fund. And when most people that I talk to about Asian stocks, they think about growth. Do you think people are surprised when they hear about the income potential?
Yes, possibly, especially in the UK. But we'd really like to highlight that both growth and dividends is something that is perfectly achievable in the Asia region. So whilst many people think of that demographic dividend story in Asia as a driver of earnings growth, there's actually a really strong dividend story here as well. So did you know, for example, that more than half the companies in Asia now have a dividend yield over 2.7%? And that dividend reinvestment in the regional Asia index now contributes more than half of the total returns generated in the region. So having been through our own financial crisis in the late 90s, many of the Asian companies run very prudent balance sheets with much lower financial gearing when compared to companies in the US and in Europe and the UK. So that means that as new growth opportunities present themselves, Asian companies are in pretty good financial positions to invest in growth, to invest in new technologies, and still be able to maintain their dividend policies as well. I might just highlight that there's also growing pressure from various stakeholders to improve capital efficiency here in the region and improve shareholder value through better shared returns. So we've seen shareholder-friendly total returns policies becoming increasingly in focus across markets like Japan, China, Korea, etc. So I think all of these points have supported the Abrdn Asian Income Fund's own dividend paying ability. And we've increased our dividend every year for the past 16 years, making this fund an AIC Next Generation Dividend Hero Fund as well.
And an announcement just literally as we're speaking about the dividend now.
Yeah, that's right. So I think that just came out just now, as you said. So I think that's very exciting, even for me as a fellow shareholder in this fund. So we've announced an enhanced dividend policy. So from the full year 2025, the Abrdn Asian Income Fund will yield a notional 7%, making this a very attractive choice for income-focused investors looking to diversify into Asia. For full year 2024 dividend, we're going to be paying 14.43 pence per share. That's a 22.8% increase year on year and represents a 6.4% yield on the last share price, although I've seen that the reaction's been quite good, so perhaps that yield will go down a little bit. There's also going to be a continuation vote every 3 years, which will help ensure the fund remains aligned with shareholder interests. And I think most importantly, there's not going to be any change in the way we identify quality dividend stocks in the region. We've got the full support of close to 40 analysts on the ground across Asia to keep finding the best ideas and to stay on top of all the dividend news here in Asia. We really believe Asia is home to some of the most attractive companies in the world, and our aim is to continue to find the best dividend ideas to support this enhanced dividend policy going forwards as well.
So what sectors are you looking at particularly? Because I know the AI story at the moment is one which is just continuing to capture investor attention. And clearly, Asia is playing a huge part in that.
Yeah, so technology and AI, I think, are still very attractive themes that we want to stay on top of in this fund as well. And I think, we talk about AI and this is an income fund, and that in itself might be something confusing for everybody who was more used to seeing telecoms and banks and real estate only in their income funds. But I think that's really one of the best things about investing for income in Asia is that it is so broad, it is so diversified, and we can find really good ideas that give us that capital growth, but also give us yield as well. So if I just stick on that AI theme, then we invest in technology giant TSMC, which makes the logic semiconductor chips that power data analysis and hardware devices that we need to use AI. And TSMC's dividend yield today is about 1.4%, which seems pretty low for an income fund to be interested in. But if you look over the past 5 years, TSMC have delivered double-digit dividend per share growth over the 5-year period on an annualized basis. And the yield looks low now because the share price has risen over 200% during that same period. So we're actually receiving a double-digit increase every year over the past 5 years in terms of dividend per share. And the yield looks low today simply because the share price has done so well. So we're getting that capital uplift and we're getting the dividend growth as well. Just at the other end of the spectrum in AI, we also own small cap companies in this fund. So companies like Sunon Wealth, which I think is about 0.1% of the market cap of TSMC. So we're really at the other end of size spectrum. But Sunon Wealth makes the cooling systems that cool down data centers. So as we consume more data and we generate more power in these servers, they need more complex cooling systems. So Sunon Wealth is a small cap company that makes those cooling systems. That company has a yield of 3.6%. And again, if I look over the past 5 years, then we've had a double-digit annualized growth in dividends from Sunon Wealth as well. So it's really about trying to play different ways to access interesting themes like AI and that global demand growth that we expect to see, but still collecting good dividends along the way.
For all the successes, and there are many, and in fact, we've had an update from Taiwan Semiconductor this morning, which has delivered, another quarter of record profits. But for every success story, there are also concerns, particularly about China, where we've seen growth not returning as quickly as a lot of people would have expected and certainly hoped for. We've seen a lot of stimulus measures. Not all of them seem to be working. And in fact, the last one seemed to throw the kitchen sink at the problem. Well, certainly kitchen appliances, giving people money back in order to buy new stuff. Do you think that this year we'll see China finally delivering on that anticipated turnaround?
So we think the recent policy moves are encouraging as they focus on boosting liquidity and boosting consumer demand, but it's not had that meaningful impact on long-term demand stimulus just yet. So even the policy that you just mentioned in terms of kitchen appliances, that's really a short-term boost that's probably just pulling forward even existing replacement demand rather than creating new demand, which is what we really need to see. So this fund has actually been underweight China for the past decade, but that doesn't mean that we don't own China at all or that we don't see good opportunities within China. So we're really still focused on finding those high quality cash generative businesses that offer compelling total returns over the long term. So even within our holdings in China, we actually have companies like Meidi, which is a white goods manufacturer, a beneficiary of this trade-in scheme. But what we like about Meidi is how they have not only been a beneficiary of some of these demand measures, but they're a really good example of a forward-looking Chinese company that is intentionally invested to create a supply hub in Central America in order to differentiate themselves by having a truly global supply chain in a world where tariff uncertainty still runs the news cycle in China. So that's been a great holding for us. We also own companies like AIA, which is Hong Kong listed, but 40% of their new business as an insurance company comes from China. And this type of company, again, is a really good way to play that aspirational consumer trend. So if we think of all the new middle classes growing in China, then these are new customers for AIA that have assets for the first time that they want to protect, or it might be the first generation in a family that's looking to work on inheritance planning. So I think as that wealth and affluence starts to grow in the Chinese demographic, then we should see good support for companies like AIA, also for some of the very bread and butter retail banks as well that provide financial services. So these are the types of trends that we're trying to play within China for this fund. So we're still underweight relative to the regional benchmark because we still only buy stocks once they confirm a dividend policy and they make that intention to share with minority shareholders. But we do still see good opportunities within this market. We do want to play that consumer growth story. So we are there. We're just not there as much as perhaps the benchmark would like us to be.
It's been absolutely brilliant to talk to you. Thank you so much for your time.
Thank you. Thanks to Yoojeong Oh for coming on the show.
And while we're talking about the US, you were talking about 20th of January as being the date for Donald Trump's second inauguration. Well, the 19th of January is also quite a big date in the United States because that is the date when TikTok is set to be banned from the United States. Now, apparently there are around 170 million reported users in the United States. It employs a lot of people over there. A lot of people use TikTok for business. And there's been a lot of conversation about the real conflict between national security and First Amendment rights, freedom of speech, and the ability to use TikTok for that freedom of speech. And certainly, as we're recording this, we're still waiting to hear whether or not the Supreme Court will block the ban. TikTok have asked them to, but we're waiting to find out what happens there. It does seem quite unlikely, if you look back at precedent, that this will happen because, this was signed into law by Joe Biden earlier in last year, 2024, and it's only just coming into effect. Now, there's been a report just in the last hour or so talking about how the TikTok ban might work, how it would impact users. The expectation had been that the legal ban prevents it being uploaded, the app being downloaded, uploaded, however you put it, by new users from the date of the ban on Sunday. But there are reports, first in the information, that TikTok is actually looking at putting up something on the screen, a pop-up message. So you try to get onto TikTok and you can't actually use it, even if you've already got it downloaded, and it just takes you to information about the ban. Now, whether or not that happens, ByteDance hasn't responded to any requests from any of the news agencies, including Reuters, to corroborate whether or not that is the case. They did come back to another story which was around, which suggested that Elon Musk might get involved potentially, and that could be considered by the Chinese government as a potential buyer of the US assets, and it would be run as part of X. Now, ByteDance has said that that is complete fairy tale, absolutely not true at all. Pure fiction was the word that they used. We haven't heard anything from Elon Musk or the Chinese government, but we do know that the Chinese government has a golden share. So potentially they could start to have conversations without ByteDance in the room. It would be unusual, but not unheard of. But yeah, we could be, by this time next week, in a position where TikTok in the United States is no more. I stress the United States. It will still be able to be used and downloaded here in the UK. Are you a TikTok user? My kids are on it all the time, Charlene. I think they would rebel if there was a ban.
Yeah, no, I am not. I've got some friends who love it for kind of like all the beauty tips. Apparently you can kind of get lots of beauty products, perhaps at cheaper prices or whatever. I'm not on it, but you know, there has been talk in AJ Bell Towers, hasn't there, about us ourselves going on TikTok, maybe doing, you know, the social media tips on personal finance and stuff. I've managed to run away every time somebody tried to approach me about it because, as I say, I feel I have no business at my age doing this, but you know, watch this space. You might see me talking about pensions, which I honestly love, but yeah, I'm just trying to figure out kind of dancing videos and pensions. I don't think my kids would ever talk to me ever again if they caught wind of that.
I think you should talk about pensions whilst doing a dance.
The thought of it, just, yeah, don't get me wrong, I'm an avid social media user, that kind of the more traditional apps, shall we say. So yeah, hopefully not, that I might live to regret those words, and reminding the powers of that be of their request. Right, we're going to bring things to a close shortly, but finally, before I do, I've got a friendly reminder for you. I'm sure you haven't forgotten that, you know, self-assessment tax deadline is creeping up, that January the 31st. So peak season, well and truly here. So last week, HMRC told us over 5 million people that they were expecting a return from hadn't yet filed. So, and even all, you know, for all you good eggs who filed early, please do not forget to pay your tax bill. I like to hold on to my cash for the until the last minute for every scrap of interest. I filed my return months ago, but I have no leg to stand on when I'm saying reminding you to pay the tax bill. But please just don't leave it too late and fall foul of those late payment penalties if you've actually already filed. And I think one thing that can catch people out, especially if you haven't filed for a few years or you haven't had a tax bill to pay, is that HMRC these days, they're so busy. They don't tend to send like a formal bill or demand anymore. I think some people are waiting for those kind of brown envelopes. Some of us will get a statement, perhaps with payments on an account due later in the year, once you filed and paid in January, but it's not always the case, and not usually an excuse for not paying on time if you have filed and have tax to pay. I will say also, you know, if you are worried about being able to pay a bill, do speak to HMRC as soon as possible if you can get through.
I must admit, I normally have been able to pay my tax bill via my tax code. So this year I've got to pay a little bit more and have been waiting for a bill to come through the door. And it was only just by Googling how do I pay that I realized actually, I won't be getting a bill and I just need to crack on and do it because yes, I don't want any of those late penalties.
Yeah, no, it does catch people out, you know, especially because you do get used to kind of waiting for that statement and being told what you've got to pay. But yeah, it can, you know, as more and more people are getting dragged into the system or dragged into paying more tax, it is going to become more of an issue, I think.
Absolutely. That is it for this week's episode of the AJ Bell Money and Markets podcast. Thank you so much for joining us.
And don't forget, please, to like, subscribe and share the podcast. We always love a bit of feedback. So you can always get in touch by emailing podcast@ajbell.co.uk. And we'll see you next week. Bye for now.
Before you go, please remember this podcast is for educational purposes, and the views expressed don't necessarily reflect those of AJ Bell or Shares Magazine. The podcast isn't telling you if a certain investment is suitable or not. Don't forget that the value of investments can change, and you can lose money as well as make it. It's also important to remember that how you're taxed will depend on your individual circumstances, and rules can change. The way an investment performed in the past may not be the same as how it behaves in the future. If you want help, go see a qualified financial advisor.